My name is Jake, welcome to the channel. In today's video, we're going to talk about the best high dividend Vanguard ETF to retire early on. And in this video, we're going to cover three topics. My content is centered around new or beginner investors. And so I'm going to take a high level approach of what an ETF is. I'm going to explain what it is and why I love investing into ETFs. And then the second part of the video is going to be, we're going to be taking a deep dive into VYM. The Vanguard High Dividend ETF. And this approach could be applicable really to any ETF, but in this video, I am going to go really in depth into VYM. And the reason why this is so important is this video is going to be really, it's years of information and understanding and knowledge that I've learned as a do-it-yourself investor. And I'm going to share with all of you things that I think about when investing into ETFs, things that I'm looking for, and things that you, the viewer, you right now, listening and hearing my voice, what you can do to replicate this for your own good, for the benefit of your investing needs. And I think that's going to be really, really valuable. So I promise you, if you're a new investor and you're not really familiar with ETFs, you will learn something in this video. So stick around for the entire video. It won't be a long video. Towards the end of the video, we're going to compare VYM and the S&P 500, because that's really what most investors are looking for is, okay, if we're going to invest into anything apart or aside from the S&P 500, we need to at least benchmark it against the S&P 500. Otherwise, what's the point? We might as well just put everything into the S&P 500. So we're going to take a look at that. And then lastly, we're going to assume that everyone that is watching this video, you're not millionaires, right? You have day jobs like my wife and I, right? You get a paycheck every couple of weeks, or maybe you're self-employed, whatever it may be. The assumption that I'm taking is that you don't have a lump sum of money that you've inherited or that you've received to just invest into the stock market. I'm going to assume that you're like me and you're living paycheck to paycheck and investing into the stock market based off of your blood, sweat, and tears at your day job. Or maybe you have passive income from real estate that you're investing. Whatever it may be, this video is not for millionaires, is what I'm trying to say. This is for your average Joe that's looking to invest in the stock market and learn to do it themselves instead of relying on a financial advisor. And then the last part of the video is going to be around looking at a dividend reinvestment calculator, what the projected income would be from investing into VYM by dollar cost averaging over the next 10, 20, and 30 years. I obviously can't speak for everyone, but in my experience in college, in school, I was never taught this. And so I had to learn this all myself, and I'm really excited to share it with you. I do it for free, right? I don't sell a course or anything. So strap in. This is going to be really exciting. You're going to learn something new. And because this wasn't taught in school, I'm going to teach it to you for free here on YouTube.
I'm going to be your sheriff. You're going to be my deputy trainees. Oh, come on. Stop whining. You're mine now. You belong to me. You're not going to have your mommies run behind you anymore and wipe your little tushes. Oh, no. It's time now to turn this mush into muscles.
I love that. Good old Arnold. All right, very cool. So in my portfolio here in M1 Finance, I have my portfolio broken down into different slices. And my largest slice is in my Dividend Growth ETFs. Here that you can see it's allocated at 50%. And the largest holdings in this slice are SCHD from Schwab and VYM from Vanguard. I also have another ETF from iShares in DGRO. But my largest holdings, VYM and SCHD, they're in there for a reason. Now, when I look at the dividend investing community as a whole, there's a lot of opinions around, okay, should you invest into ETFs or individual stocks? And there's a lot of benefits and a lot of cons to both. Surprise, surprise. There's no one answer for everyone. So when it comes to that topic, investing into ETFs or individual stocks, I shared an entire video a couple of months ago exactly on that topic, about 6 months ago. And you can check it out. It really goes into depth around why I invest into individual dividend stocks and into dividend ETFs, and it breaks down the pros and cons of both. Now you might be thinking to yourself, well, Jake, I don't even really know what an ETF is. And that's completely fine. Everybody here following the channel is at a different level. And for those of you that are maybe a little bit unsure of what an ETF is, you can kind of think of it as like a basket, right? You could go to the grocery store and you could buy a banana, a strawberry, an orange, blueberries or grapes individually. You could also buy like a gift basket and you could buy it all in one. And that's the way that I think about it. If you want to buy an individual stock like Coca-Cola, you could buy this, this thing of bananas, right? And you could buy it individually. If you wanted to buy a gift basket and just hand somebody a present with a bunch of fruit in a big basket, that would be an ETF. You're getting that ETF or that basket at one price instead of having to buy each one of these individually. And every ETF or every basket is tracking a different index or has a different methodology. Some of these baskets are actively managed. And these are what we call active mutual funds or active funds. And those are not really what I talk about on my channel because they come with high fees. The ETFs that I talk about and the ones that I am more of a fan of are your index or your passive ETFs that follow a specific index, and there's not a portfolio manager taking fruit in and out on a regular basis. One of the things that I love about investing into ETFs is it's self-cleansing. If a company in an index is underperforming, it falls out of the index and another company replaces it. And you as the investor don't have to actively do that. The ETF is doing it for you. Now let's take a deep dive into VYM. And as mentioned, you could replace this with any other ETF that you're interested in. But for this example, I'm going to focus just on the Vanguard High Dividend ETF in VYM. And in order to do that, we're going to need a few resources. And the resources that I use to get the information that I'm looking for is I use ETF.com. Occasionally, I will use Yahoo Finance. I don't use it as much, but I use it from time to time. I also heavily rely on seekingalpha.com to get my different information. And we're going to be going back and forth from these websites, and each site serves a different purpose, and you can get different information from each of these websites. And I'm going to show that here in a second. The next site is from Vanguard itself. When you go to Vanguard, you're going to get very specific information on the ETF. And if you're ever unsure when you're researching an ETF, it's always best to go to the issuer themselves. So if you're curious about a Schwab ETF, a Fidelity ETF, a JP Morgan, Vanguard, whatever, go to the issuer. Go to the issuer's website, go look and see their performance, the overview. What I've noticed, there can be inconsistencies on these other websites because essentially they're pulling their information from Vanguard. So it's important to understand that if you are seeing inconsistencies, the most reliable source is going to be from the issuer themselves. Okay, so let's go over here to ETF.com. And if we look at VYM, the first thing that we're going to look at is we're going to look at the fund description. What is it? And as you heard me say before, ETFs are typically following an index, and every ETF has a different index that it's following or a different methodology in which they're tracking and adding the companies that they're holding in the ETF. So VYM, as it states here, tracks the FTSE. This is the Financial Times Stock Exchange High Dividend Yield Index. And the index selects high dividend paying US companies and excludes REITs and weights them by market cap. Okay, so this is a lot of information to digest, and let's take a look at it. So first off, this is based off of the US. If you just Google FTSE, you're probably going to get like the London exchange or a different exchange depending on where you're at in the world. But what we're looking at here is the US exchange. And very, very important is it's excluding REITs. So real estate investment trusts, these are real estate companies. And REITs, as we know, if you've been following the channel, are taxed very differently than non-REITs or non-bond, like qualified dividend paying companies. So very, very important. So right off the bat, you're focused on the US, you're excluding REITs, so you're getting the most favorable tax treatment, and then it's weighting it by market cap. The reason why I like it that it's weighted by market cap is it reduces the risk and the volatility, because the market cap, the higher the market cap, traditionally, not always, the more stability there is and not as much fluctuation. A few things that we're going to look at from here is the inception date. When was this ETF created? I really like looking at ETFs that were created before the financial crisis because I love seeing how these ETFs performed in both good economic times and bad economic times. I think every ETF under the sun, as long as it was investing in equities and not shorting the market, they did well from 2010 until 17, mid 18. But I like it when we can go back and we can see the good times and the bad times in the historical performance. And as always, everybody, we know historical performance is no guarantee of future performance, but it gives me the warm fuzzies inside. I like seeing it in good and bad times. The next thing, this is probably the most important thing that I look for, is the expense ratio. The expense ratio is really the cost that you're paying to own this ETF. And it's not something that, that comes out of your bank account or gets subtracted out of your account. You're not going to see an expense on a monthly, quarterly, yearly basis. It's really just taken out of the NAV, the net asset value, the total value of the ETF. So really, really important there. And then the assets under management, this is how popular the ETF is. How many, people are investing, the amount of money that's held under management by this ETF. Okay, so if you see assets under management and you're looking at an ETF and it has under $1 billion, it's either a very new ETF or a very not a very popular ETF. All right, and so let's take a look at a few other things that I look for when looking at this. I like seeing the average weighted market cap. This is 147 billion. So when we look at this, 147 billion, that's pretty damn big. Like, that's a big company, right? We're not talking about small caps here. This is more your enterprise, larger companies. And a few other things that I look at, obviously the distribution yield. This is the yield that it's currently yielding today based off of the share price and the historical payments, the payouts, not future. So important to note there. Also very important is the number of holdings. How many companies are held in this basket, in this ETF? Some ETFs have a large amount of companies held. Some have a very small amount. So this is something, in my personal opinion, the more holdings there are in an ETF, the less volatility you'll see. You're not going to see these big swings to the upside and also to the downside. You're going to get more market returns, like average returns. And I personally, as a long-term passive investor, I kind of like that, to be honest. All right, so what we're looking at here is weighted by market cap. The index selection methodology is based off of the dividends. So we're looking at the market cap and the dividends. All right, so it's focused only on the United States. So there's no international exposure. There's no real estate exposure. So this is the cream of the crop when it comes to tax efficiency. Very, very good. If you're going to hold this in a taxable account, not a tax sheltered account, it's not going to kick you in the butt as much as another ETF that holds, maybe bonds or REITs. Now let's take a look at the top 10 sectors in this ETF. And this is the one thing that you will notice. Remember how we talked about, looking at different resources from Yahoo Finance, from Seeking Alpha, right? You can see on Seeking Alpha, you'll get the same information here. In some cases, this will be different. And that is because the funds are being updated on a quarterly basis, right? And so they are going to shift, and based off of the how frequently the websites are updating this information is what you're going to get. So if you do look back a year ago, and we'll take a look at this in a second, a year ago, this looked very different because the index looked very different. But this fund is weighted heavier in financials, heavier in healthcare, and less heavy in telecom and basic materials. If you look at the top 10 holdings, this is what I typically look for. This is really, really important to me, is to understand, okay, how heavily weighted is this ETF? Now, for example, if the top 10 makes up more than 25%, that's where we're getting a little bit more. In my opinion, it's riskier because we're focusing more on a small subset of companies versus equally weighting them or spreading out the weighting across all of the different companies. As we mentioned, there's over 400 companies in here, and so these are pretty heavily weighted, right? The top holding in JP Morgan, just under 4%, Johnson & Johnson, Procter & Gamble, Bank of America, Intel. A lot of these companies, your average person here in the United States and also international are going to recognize these companies. Now, when we look at the individual holdings in here, you can see that this ETF, because there's over 400 holdings and the top 10 are weighted, a fourth, there's going to be a long tail. And what that means is the lower end, the smaller weighted positions are going to only have make up fractions of what the top 10 are making. So if you scroll down here and we can take a look, you can see, I think I saw, McDonald's, Texas Instruments, you got Philip Morris, you got Caterpillar, Morgan Stanley, right? You got Altria Group, you got ConocoPhillips, Air Products and Chemicals. And you look at this, Air Products and Chemicals doesn't even make up 0.5%. So really interesting. You got Kimberly-Clark, a lot of these companies that I own in my portfolio, right? And so you got Phillips 66. Let's just go down here. I'm not going to name off every single one, but you kind of get the point, right? 0.13% with Kellogg, right? Compared to 3% is a substantial difference when it comes to the exposure that you're getting from these different companies in this ETF. And so if you do want to see a little bit more information on the individual ETFs, you can go to Vanguard.com, you can look up VYM, and you can see under prospectus and reports, you can click on the annual report here, and you can pull up and you can see all the individual holdings in there by sector. And you can see, this was based off of, October 31st, 2020. And then if we scroll down here towards the middle, I guess you could say, you'll have all the information in terms of the performance. And this is what I was getting at earlier. So this was the allocation in October of 2020, right? Financials, 19%. Now today, here in 2021, it's over 20%. So this is going to change, obviously, as the index changes, right? The FTSE index that this is following is going to change every single quarter. And this is what I was getting at. You can take a look at and you can see the individual holdings if you really want to nerd out on this. I personally like this kind of stuff because I guess I just don't have anything better to do on a weekend. But if you want to take a look at this, you can check it out and you can see how the individual holdings make up this ETF. Now, if you wanted to see the historical payout of the ETF, you can go over to seekingalpha.com. I personally like seekingalpha.com the best when it comes to looking at the dividend history. You can look at the chart here. And as you can see, it's up and down, quarter over quarter, because the companies in this ETF are paying maybe on a different schedule. It's not as consistent. Like if you were to invest just into Coca-Cola, it's a little bit more reliable in terms of what you're going to get quarter over quarter. And that is one, advantage of investing in individual stocks is that, assurance and consistency of what you're going to be paid per share. But if you scroll down here, you can see the historical payment. You can see, okay, last year in March, we got paid just over 55 cents per share. So every share that you owned of VYM, you got paid 55 cents. Fast forward to 2021, for every share that you owned, you got paid 65 cents. That is what we call dividend growth investing. If you owned VYM in the beginning of 2020, you were getting paid 55 cents per share. And let's say you didn't add anything to your portfolio, you kept the same amount of shares. Fast forward a year, you're now getting paid 65 cents for every share that you own. That is amazing. So you can see that the dividend increased from 55 cents to 65 cents year over year. And you can see if you want to check out the historical dividend growth rate of this ETF of VYM, you can go over to the dividend section under dividend growth, and you can see here under the 10-year, 5-year, and 3-year. This is, for example, the 10-year dividend growth rate, the CAGR. The CAGR stands for compounding annual growth rate, and this is just looking at the dividend. Very, very important. This is not looking at the share price, the capital appreciation. This is just looking at the dividend growth. So over the last 10 years, this ETF has increased its dividend by over 10%. That is incredible. So as I mentioned, I use these different websites for a reason. Seeking alpha is great when you want to find the dividend growth rate, you want to find the dividend history, you want to find the dividend yield. And I really enjoy using ETF.com, right, what we were just looking at, for when it comes to those other things like expense ratio, the inception date, the assets under management, all of those other things. I really rely on ETF.com. And as mentioned, if you're unsure, you can always go to the issuer's website directly. Now let's compare how the Vanguard High Dividend ETF in VYM compared to the S&P 500. And to do that, we're going to compare it to the VOO from Vanguard, the S&P 500 ETF. And a lot of new investors may just go to something like Google Finance, Yahoo Finance, and just compare the two ETFs and look at just the share price and see, okay, well, the S&P 500 is up almost 100%, where the Vanguard High Dividend ETF is up around 50%. And they might, conclude there, all right, the S&P 500 destroyed the High Dividend ETF. Now, if you were to do this, you only looked at half of it. You only looked at the share price. You didn't look at the total returns. Now, let's take a look at the total returns with the dividends being reinvested. So in order to do that, we're going to go over to a website called DQYDJ, and I'll leave a link to this in the description below if you want to play around with different ETF tickers and run your own, simulations or whatever. So if you go down here and we take a look at VOO and we look at the time span of investing, let's say, for example, you invested $10,000 on April 11th, 2011, 10 years ago. If you did that, if you invested just in the S&P 500, you would get an annual return of 14%. Your final value would be a little over $37,000. So annual return of 14% if you just invested in the S&P 500. And as we know, from 2011 to 2021, that's been a pretty big time for the stock market. You've had one of the biggest bull markets in history. So the S&P 500 definitely, saw the returns from that. So what would it look like if you invested the same $10,000 on April 11th in 2011 into VYM? You would have an annual return of 12% and just over $30,000. So if we compare the two in terms of the total return with the dividend reinvested, you can see that VYM is actually not far behind. VYM and VOO serve very, very different purposes when it comes to your investing strategy, whether you want to live off of the dividend or if you're investing just for capital appreciation. So it's really exciting, and you can invest with confidence that over the long term, if you're investing into VYM and you're looking to retire, whether today or in 5 years or 10 years, you're going to get comparable total returns as the total stock market. Now, obviously, this is based off of historical returns. Historical returns are never a guarantee of future returns, but for me as a dividend investor, it kind of gives me like that, well, hell yeah, VYM ain't so bad after all. You got a lot of people saying that, you should just invest in the S&P 500 because you're going to get better results. Well, the numbers don't lie. So there you go. All right, now let's take a look at my favorite part of this entire video, is looking at the numbers and seeing what it would look like potentially in the future if we invested just into VYM, right? Now, I've shared this calculator a few times on the channel. I leave it in the pinned comment. It's for free. You don't have to pay anything. It's just, I don't feel the need to charge anybody for this. I just, you can have it for free. All you have to do is click on the link. It's not an affiliate link. It's a Google sheet. You can click on it. You click on file. You click over here, make a copy. And if you make a copy, you'll be able to adjust the numbers and save it to your desktop, whatever. And you can see here that there's already some people using this. I've shared this a few times here on the channel. So what we're looking at is everything here in yellow is all that you need to update if you want to look at something specific to your scenario. Say, for example, you have $30,000 in your portfolio today, and let's say you're able to invest $2,000 a month. Let's say you're a badass, you got a great job, you're side hustling, right? You're doing great, you got a high savings rate, you're investing $2,000 a month, you're dollar cost averaging, and you're investing in your investment. VYM is appreciating about 9% every year. It has a growth rate of 10.5%, and the current yield is just over 3%. Now you might be asking yourself, well, Jake, how did you get these different numbers here? I leave down here below the instructions on how you can do this with the different links, but let me show you really quick how we got these numbers. So if we're just looking at VYM, if we invested everything into VYM, let's say VYM right here, right? You're investing everything into VYM. How we're going to get these numbers is going back over to seekingalpha.com. So when it comes to getting the yield, what I like to use is you go over here to Seeking Alpha, go under dividends, dividend yield, and then go over here to the 4-year average dividend yield. Do you remember what I said at the beginning of the video? My channel is not for millionaires. This channel is for people that are working at their day job or living paycheck to paycheck. So I'm assuming that you're dollar cost averaging. And so what I like to use is the average yield over the last 4 years. It doesn't really help me to look at what the current yield is because I'm averaging into my portfolio over time. And that's why I take the average yield. I follow a lot of other dividend channels and nobody talks about this. No one talks about this. And this is so important because if you are dollar cost averaging, this is the number that you should be focusing on, not what is currently yielding, especially if you're dollar cost averaging and you're not, picking individual stocks and you're just averaging in, this is what you should be looking at. So that's how we got the current yield. But what about the dividend growth? So to get the dividend growth, you go back to Seeking Alpha and you're going to go under the dividends tab under dividend growth. And what you could use either the 10-year CAGR, the 5-year. I personally, you could use whichever one. I like the 10-year because I just like it because it's more representative of what the fund has done over a longer period of time. It's no guarantee of the future, but I just like using the 10-year. So I'm going to use the 10-year. Now for the capital appreciation, how we're going to get that is we're going to go back to this website that we were using earlier, and we're going to take a look at the total return. The total return was 12%. Now, obviously, if you update the dates here, this is going to change, right? If you update it to 2 years, 3 years, 5 years, it's going to change. Like there's no crystal ball. Because they're over a 10-year time period, I feel more comfortable using them. I wouldn't feel comfortable using it if it was just a 1 year because you could have a black swan event like we had in 2020. That's why I like having it further back. Okay, so we're taking 12%, but we know that the average yield was just around 3%. So we're going to take 12, subtract 3, and that's how we get the 9 for the capital appreciation. Okay, now everybody is up to speed. We got all the numbers in here. We know where we're at. And once again, you could replicate this for any ETF, but for this example, we're looking at good old VYM. And once again, you don't have to update any of the other fields. All you have to update is what is in yellow. So if we assume that we're reinvesting the dividends and we're adding that much in capital for the next 10 years, which is obviously unlikely. We don't have a crystal ball, but let's say, what the hell, we did it. We did it for 10 years. We didn't add any more, any less. We could reasonably expect with the metrics, the numbers that we're looking at, after 10 years to have over $18,000 in annual dividend cash flow. This is passive income. This is looking at just the dividends. 10 years, that's not bad. Now let's fast forward 20 years. In 20 years, we'd have just around $90,000 in dividend cash flow. And in 30 years, we'd have just shy of $400,000 in dividend income if we were to do this for 30 years. This is the power of compound interest. If you're in your 20s right now and you're watching this video, you should just be drooling out of the mouth right now seeing this. This is absolutely incredible. And what we were just looking over there was just the dividend, but that's not even looking at the capital appreciation. In 30 years, with reinvesting the dividend and adding the $24,000 every year, you're going to have over $8 million in your portfolio. This is absolutely incredible. And the most amazing thing about this is it's truly passive. This ETF is truly passive. It's not something that you have to follow up on a quarterly or a biannually basis. It's passive. It's self-cleansing. And that is why I love investing into great ETFs, dividend growth ETFs, and high dividend ETFs like VYM. Thank you so much, everybody, for watching. I hope that you learned something new, and I'll catch you in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.